So we're going to chat with Keith Mullins now, who's been a market commentator on European banks for many decades. Hopefully he's going to give us some insights into how the regulation's working, or not maybe, what is going on with capital ratios, whether one can trust those numbers, and really try and give us some insights into systemic risk. There's a lot of chatter in the markets and in the media about the Spanish banks, the Italian banks, and let's see what he has to say about those too.
Having said all of that, I think while we have a system of overbearing regulation and stifling regulation, I'm not entirely sure that the system we have whereby banks have forced effectively to bail in bondholders is either fit for purpose, because the reality is, my fairly stridently held view is that states will continue to bail out banks because, as they see it, the political risks of not doing so and the risks to pensioners who've been sold several billions of dollars of subordinated debt stand to lose all their money. So, I think if you look at the cases of Monte dei Paschi di Siena, which is in the process of being bailed out a second time, the two smaller Italian banks that have requested precautionary recapitalization for the European Union, where we've had post hoc restitution of bailed-in bondholders in many cases, including Cyprus. We've had situations where the banks are setting up passive restitution or some kind of emergency funds to pay out to pensioners who notionally lost money. So I think we still do have that sovereign put on the banking system. So if the question is, are we in a better place? In absolute terms, you can say, fine, look, we've got much higher levels of capital and liquidity, but has the system been tested? No. Are banks actively now lending into the economy? Because don't forget, banks exist primarily to lend to customers and to finance economic growth. This is real economy lending. And we've had very little, precious little of that. And I don't think anyone really could put their hand in their heart today and say they feel safe and secure that there won't be another banking crisis or another reversal or something that creates a huge sort of blip or explosion. In the banking sector, you could say that it's not systemic, that most of the risk is now going to be idiosyncratic, and that's potentially a fair point. But if you have multiple idiosyncratic risks, at what point does that become systemic or sector-wide?